Today, I'm gonna do something very special. I'm mainly gonna reveal my investment strategy around picking explosive growth stocks that go up hundreds of percent. I have a good track record with picking them in general. Most of those stocks were documented here on YouTube, with my largest gainer being Mama up to 750%, HIMS up to 550%. Robinhood, I talked about it last year, it went up to 300%. And as of late, it was Ouster, which I showed it on YouTube, and it's up 100% year to date. So I know a few things about picking growth stocks and some common attributes to research and to find those explosive growth companies. So I'm going to talk about all of this today. It's all free on YouTube, and it's not going to get a lot of views because people, again, enjoy other kind of content talking about popular stocks versus boring educational content. So if you do enjoy them, all I'm asking is please press the like button and let me know your opinion down in the comments below. Now, I have to be honest, just like I had those amazing gainers, I also had some losers along the way. The losers have been much less than the gainers and the massive winners. But the best part about picking growth stocks in general and about investing is that investing by itself, by nature, is an asymmetrical game. So your loss is limited to how much you're putting in, but your upside is unlimited. If you put in $1,000, you can only lose up to $1,000, but your gains are uncapped. It could be $10,000, $100,000, $1 million, $10 million on this $1,000. So it's a pretty amazing game in general. Now, when you pick those growth stocks, you're pretty much increasing the ceiling on the upside. You have a higher chance of making more upside, but you're also taking a higher chance of a potential downside. Now, this is when position sizing comes in. I normally put in small percentage of my portfolio in those stocks. So if I'm right and they go up 100%, I don't need a lot of money to generate pretty amazing returns. But if I'm wrong, then the losses or the errors are very small, and I only have to be right on one or two or three of them, or only one Palantir or one of those stocks for it to make up for all the small losses and much more. So this is the nature of the growth investing game, and that's how I implemented it, and that's how I learned it myself. Now, before I get into the attributes of the growth stocks I look for, you have to really understand how the market cycle works in general to be able to identify those investment teams and those, you could say, stocks in general. Now, generally speaking, we start around optimism, and this optimism is built on a certain team, a certain thesis that investors have that's making them really bullish on the market in general. For example, between 2019 to 2022, it was mainly EVs, electric vehicles, climate change, Beyond Meat, Tattooed Chef was a popular one on YouTube, it was a bubble, Tesla, and many of those stocks were anything around clean energy and climate change and all these things. They were really popular. That was the major investment theme, and we reached euphoria. Once you reach the euphoria phase where you can no longer justify the fundamentals and reality and expectations are just crazy between each other, then you start having a pullback, okay? And after the pullback of 2022, the AI theme has emerged, and it's still active till today from 2022 to 2026, and it has been through subcategories. For example, it started with powers and semiconductors. Very recently, it's been the neo clouds and infrastructure related stocks. After that, it's maybe Fiscal.AI and robotics. That's why Ouster is doing well. So it's been broadening out to different subcategories within AI in general. Now, what you really have to understand is that the specific theme that has worked in the past is highly unlikely to work again after you have a pullback and you come out of it. You normally come out around a new theme or something that's exciting investors. It's very rarely the same theme. It's normally a new theme, and it's normally a new leadership of stocks. So the stocks that led the previous bull market are unlikely to lead the next bull market. There's always exceptions. Palantir was one. It has led multiple teams, multiple bull markets. Same thing with Nvidia, same thing with other stocks. But generally speaking, the leaders of the old bull market are unlikely to be the leaders of the new bull market. After we have a correction, you normally have a new team and you have a new set of leaders that lead the next bull market forward. So whenever you're looking for those stocks, you generally speaking have to look for something new, something that really was really popular and everyone was talking about it in the previous rally. You have to kind of look for something new. But again, there's exceptions to the rule and maybe sometimes it's different, but generally speaking, this is how the market cycle works. Now, in terms of identifying those stocks in general, the first thing I look for is a very large TAM, a large total addressable market. So when I looked at Robinhood, I saw the fintech disruption as a massive TAM, trillions and trillions of dollars from those old banks like Wells Fargo and Bank of America and the old brokers and Fidelity. People want something faster, something new, something more engaging. They want access to more stuff. Robinhood was innovative, it was delivering, and I really liked it because it had a large total addressable market. It's the same thing with Ouster right now, with a lot of the Fiscal.AI stuff and a lot of the sensors. All the robotics require sensors, all the drone deliveries require sensors, all the drones in military applications require sensors, all the self-driving cars require sensors, all of them require sensors, and Ouster is selling those sensors. So the TAM here was absolutely massive, tens of billions of dollars, I would say hundreds of billions of dollars. So you generally need a large total addressable market. Okay. The second thing you need is you need to pick the industry leader. So normally people, they identify a team, they identify something, they look at the stock that's the leader, that's really innovative, that's doing everything right. And I say, oh, that's too expensive, but there's this other one that's a little bit cheaper, and maybe I'm going to pick this one. Now, generally speaking, this is a mistake because those leaders, they tend to continue leading and the laggers generally continue to lagging for good reasons. This is not always the case. We've seen it with NVIDIA and AMD, but we've also seen it with many others where the laggers continued to lag and the leaders continued to lead. It's the same thing with Ouster and a lot of the Fiscal.AI stuff. There were a lot of LiDAR stocks. When I picked Ouster, they told me this one is cheaper, this one is doing this. But Ouster was the clear leader, it was the most innovative, and they were getting closer and closer to profitability. So Ouster did much better than the rest because it was a leader, and in most cases, it's worth paying up for the leader and not really looking for the second or third or fourth best. This is very, very important. The third one is I look for price to sales of under 10. So anytime I'm buying a stock, with a price to sales, not revenue, not earnings, price to sales of over 10, you pretty much have a higher odds of losing money. Like the more you go above 10, the more speculative it becomes, the harder it becomes to justify the valuation. So I try to stick with a maximum of 10 times sales. Like if it's trading at 15, 20 times sales, I might look into it, but I think that would be like too extreme for me and the odds are against me. But if it's under 10 times sales, then I don't only have the chance of price appreciation through revenue growth, but I also have the chance of a multiple expansion. And this is what we call the twin engines, which is not only profits growth, but also a multiple expansion. If you're buying it under 10 times sales, you're likely early, and you likely have a better chance of a multiple expansion. If you're buying it above 10 times sales, you are actually risking a multiple contraction, especially in the wrong market. So I only pick stocks with under 10 times sales. This is my limit. I also pick stocks with a minimum of 20% revenue growth, ideally 30% plus, but they should be growing in revenues at least 20%. And I prefer companies that are reaccelerating in revenue growth on a quarterly basis. This is something that I like very, very much, but my minimum is 20% revenue growth. Okay, something else I look for is the company has to be within 1 year of profitability. When I bought HIMS in 2023, it was within 6 months of profitability. When I'm buying Ouster a few months ago, it's expected to be profitable in 2027. The reason why we want those companies within 1 year of potential profitability is to minimize dilution as much as possible. Because if the company, like for example, the quantum stocks, Rigetti or whatever, it's not expected to be profitable 2028, it's still expected to lose money. So it's likely going to lose money into 2030, 2031, maybe they will never be profitable. Such companies will dilute a lot of stock, and if they issue more shares, you have much more shares, much more of something, much more of gold, let's say. Gold becomes less valuable. It's the same thing with those stocks. The more they issue shares, the less valuable those shares are ultimately going to become. So you want to kind of get in at the end of the dilution phase, and the best way to do it is to try to buy stocks within 1 to maybe 1.5 years of profitability. But if it's something, I don't know, like Archer or Job Aviation with flying taxis that won't be profitable before 2035, that's not a game that I'm interested in playing. And I believe it's like too speculative, and it could help you avoid a lot of mistake. Now, there's something else I want to talk about, which I don't know if anyone really talks about it on YouTube. And this is something I learned years and years ago. And it's mainly around relative strengths in general. So there's someone I was working with, you could say 7 years ago. And he told me something. And what he told me is that whenever the market goes down, you have to try to buy the stocks that are down the least. And I looked at him and I was really surprised, because generally speaking, we like to buy stocks that are down the most in the correction, because you feel like, oh, the stock is down 50%. I'm getting a discount. I'm getting a bargain. I'm getting all these things. But if you buy those stocks that are down the least, the reason why they're down the least during this pullback is because there's a lot of institutional investors, and you could say the smart money is likely starting to accumulate those stocks. And this is why they're holding up better than the overall crowds. They're not down as much as others. That means there's a lot of interest. And that means that this stock will likely explode like a spring in the right market once the market starts to recover. And this is, again, an insight that has helped me identify a lot of stocks. One of them was Robinhood. So I started buying Robinhood at $32 in April of 2025. When I was buying Robinhood, it was down like 20% year to date. That was the worst, was down 20%. But many growth stocks were down 50. SoFi was down 50%. Others were down 50, 60, 70%. So people were asking me in my group, why am I buying Robinhood while those other stocks were down much, much more than Robinhood? And I noticed Robinhood was acting strong. It wasn't going down as much as the comparables in its industry group. And I just noticed a lot of strengths on the company. And without any technical analysis, I felt that a lot of institutional investors are likely accumulating, and this stock will likely explode in the right market. And this is what happened. The stock went from $32 to $150. I trimmed some shares at $150, and I still have a position for the long term, and I'm still up about 200% from April. So that was one that I was able to notice by using the relative strength measure. But this is not a rule to the game. There's always exceptions. For example, Ouster in this latest pullback was really weak. The stock went to $17. So I can only imagine skipping Ouster because it wasn't showing strength. So it's not like a requirement. There's no like a trick where it's always the same. It's never really the same. But those are things you have to look at and to try to, you could say, use them to your advantage. But those are the things I really look for. Large total addressable market, industry leader, not the third or fourth best, the best or maybe the second best, maybe. Under 10 times sales, never above 10 times sales, 20% plus revenue growth within 1 year of profitability. I would prefer insider ownership if possible, but it's not really required. And possibly some relative strength in a overall market that's going down. So you don't really have to identify them early. Like, you don't really have to be early on those stocks. You could look at stocks right now that are doing well. And if we have a pullback and they go down a little bit less than others, it's trading under 10 times sales, it's fairly valued, you're pretty much buying a leader at a discount with no reasons to the company, but just because everything else is going down. So you don't really have to be early. You just have to be able to identify them and buy them near inflection points in general. Now, in terms of potential opportunities that I'm seeing right now in the market, and those are the stocks I'm looking for after Ouster, as I did well with Ouster's up 100%. I'm starting to look for the next one. I'm still in physical AI. So if you look, for example, at humanoids are becoming more and more popular as an investment team. Although I believe we're like 1 to 2 years early from them becoming more popular in real life in terms of applications, but the market is forward looking. Now, if you look at the cost of humanoids, only 20% of the cost is in sensors, which outsource selling, and about 50 to 60% is in actuators and brakes and other kind of things, but mainly actuators for those robotics. It's about 60% of the cost. So I invested in a company that has exposure to actuators trading at 14 times cash flow. So it's, like a call option on that. But I'm looking more into Fiscal.AI. Something else I'm looking at is tokenization. So tokenization is a $300 trillion plus market. Real estate could be tokenized, bonds could be tokenized, stocks are being tokenized, and they will be tokenized more in the future. Art, gold, collectibles, this is massive. It's happening on the Ethereum network, and there will likely be many, many winners. So I'm looking into tokenization as well. I'm also looking into fintech. Although I own Robinhood, I think Robinhood is the leader in fintech. SoFi is good, but I think Robinhood is the leader. And I think there's still a lot of market share to be taken away from a lot of the banks and a lot of the big players and a lot of those, you could say, companies that people don't want anymore. You have a newer generation that wants something easy, special, something that's quick, something that's just easy to understand. And this is when fintech comes in. And I think it's only getting started. Now, the last one, which is a stock that I'm researching and I'm looking into it more, is mainly around AI medical discoveries. So if you think about AI right now, most of the winners are around data centers, infrastructure, semiconductors, and all of that is great. Okay. But what's going to come after that isn't just physical AI, but is mostly companies that will benefit from AI in general. Now you have the companies that are benefiting from, you could say, selling the AI hardware, but AI itself will lead to more benefits. So I'm looking for companies that could benefit from, you could say, the products of AI. For example, it could be a company with a lot of warehouses that could use some automation from robotics like Amazon is doing, and it could double or triple their margins. This is something that's not being priced as an AI winner yet. But what I'm mainly looking for is an exposure to, you could say, biotechnology in general, or mainly you could say things around medical and pharmaceuticals in general, because I think AI could potentially lead to much more medical discoveries, maybe something around cancer, hopefully, maybe something around reversing aging. There could be just so many things where AI could help us identify and potentially put up and find new drugs. So I see those biotech stocks as a potential next bull market leader. They're starting to go up, but not a lot. So I'm looking for a company that has a call option on a lot of different clinical trials. What if one of them ends up being around cancer or reverse aging or something? The stock will skyrocket. But if it doesn't end up being that, they already have legacy contracts and legacy drugs that will do well, and the stock could go up no matter what if my thesis plays out. So that's what I'm looking for. And by the way, I share everything I do in all those stocks and everything in my group, and I'm working on a product, you could say, to identify those bull market leaders early, and hopefully I can put it together in the next few months and I'll be talking about it. But that was my opinion and my explanation of my investment strategy. Hope you enjoyed it. Hope you learned something. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.